Welcome back, everybody, for our first panel of the day, How I Funded My Company from Bootstrapping to Pursuing Venture Capital. Our moderator today is Jared Johnson, who is the co-founder of Season 3, an outdoor footwear brand. He's also a graduate of MIT Sloan, the Kennedy School of Government at Harvard University, and Purdue, and he's also part of our Kinetic team. Welcome, Jared.
Hello, everyone. Good morning. I'm happy to be kicking off the first panel of the day, and this one is an exciting one for me. We're going to talk about fundraising. So the title again is How I Funded My Company from Bootstrapping to Pursuing Venture Capital, and we've got a wide range of different experiences here. Welcome everyone to the stage. I hope you're as excited as I am to kind of talk about this topic, and reading about all of your experiences. I'm sure that we're going to have a vibrant conversation about fundraising today. So I'm going to start this off. I've got some specific questions for each of you, and then we'll kind of jump into some general questions that you can go through and answer in a panel style. But Dawn, I want to start with you. You're the first Black woman to raise over $1 million in a secure token offering. For those of us who don't know what that means, could you help us understand, what is a secure token offering? Why did you choose this path? And, how did you prepare to actually raise money in this way?
Definitely. So I want to definitely clarify, I was the first female founder of any race to raise over $1 million in an equity crowdfunding campaign, and in particular, a secure token offering, which is essentially tokenizing your cap table. So in general, when you have a company, so we have a C corporation, and we have shares, and people can have purchase equity, and then they have shares. They're called shareholders. But in the instance of a token offering, instead of issuing someone a paper stock certificate or just having them listed on your cap table, when you tokenize your cap table, that data around their share is actually stored on the blockchain, and so it's just a really secure way to basically sell and transfer securities. So it's a security token. It's not a utility token. You can't buy anything with it. It was a security token. And at the time, I chose this route of raising capital because I wanted to be able to leverage the community under the Jobs Act. So I wanted to be able to crowdfund, but I also wanted to be able to offer early liquidity options to my investors. And so with the token, if anyone's familiar with cryptocurrency or blockchain technology, with the token and token sales, you can actually trade them on exchanges. Unfortunately, the SEC has not yet passed or allowed for a secondary exchange. So we have not yet issued those tokens. So currently we have over 5,000 equity holders in the company, but that was through equity crowdfunding. And I did that to really level the playing field and allow everyone to invest in my company. So I essentially bridge the gap between venture capital investors and everyday people.
That's really interesting. So can I ask a follow-up question on that? For people who are interested in possibly pursuing raising, through a secure token offering as well, are there specific resources you point out and say that, they should look into?
Yeah, so I definitely recommend looking into equity crowdfunding. I actually have a blog on Medium under Dawn Dickson, and there's many resources out there for equity crowdfunding. I wouldn't encourage a token at this time. I wouldn't encourage anyone to launch a token until there's a secondary market and opportunity for those tokens to be traded or exchanged. So I did this offering in 2018 and 19. When there was a promise of an exchange coming. But now I think it's just a great thing to just do a general equity crowdfunding campaign, offer shares of your company to the public. And you can do that across many platforms, including Republic, Start Engine, WeFunder, Seed Invest, and several others.
Thank you. So I want to jump to Reggie. Reggie, I understand that you talked to over 100 different venture capitalists on your way to raising, for your company, which is a story you hear a lot. I want to know, what can you share about your journey in experiencing something like that, kind of going through so many different meetings and so much outreach?
No, absolutely. So thank you for having me this morning. So when we talk about in the realm of biotech and life sciences, usually you have to show effort and show just prudence of kind of where you're going in order to actually get any traction and any capital anywhere. That's pretty much primarily true in the biotech market. However, usually when you hear about stories of founders in the biotech area who just have an idea and are able to raise $13 million or $15 million or $20 million, you want to be able to track yourself to the same types of groups at the same time. So I went from, areas, groups in the clusters in Boston, Cambridge, DC, California. I went to France, I went to Poland, I went to Japan, I went to Texas, I went to Florida, with all these certain meetings to happen, and yet there was still no traction. So with much of what I understood was, as I was, within that whole campaign, I was also working on small business innovation grants from the government. So I was working with groups like the NIH, National Institute of Health, the CDC, the FDA, DOD, Department of Defense. And we were able to raise non-dilutive capital from these groups as well. So it started giving us that engine on some of the deep R&D research that we've been wanting to accelerate ourselves. And as we started shifting that model from going to VC to now just focusing on non-dilutive capital, we started working within the opportunity realm within the government space. So whether it's through many of the agencies that I just mentioned, but also many of the large partners that are looking for these types of opportunities to invest into organizations. So I started working with a lot of large companies like Pfizer and Merck at the same time, because they're incentivized to work with small businesses like us, especially minority small businesses like us. And we were able to provide that intellectual capital. They were able to give us that intellectual capital so we can be able to utilize that as far as assets and IP to now transfer that into something tangible to now raise funds from VCs and angel investors as well. So, this has been a long journey where even during the course of these 5 years that we've been in existence, we've been working pretty hard to try to raise the capital from many different sources. So it was just recently, last year, where we turned on the fundraising engine. By October, we raised 1.25 million, and we're now on track to raise 5 on the C2 tranche. So we're finding our way and finding our avenue to keep growing.
Thank you. Very interesting journey there. So Xiomara, I want to give you an opportunity to speak to your experience, which I hear, given that you're in the retail space, it's been quite unique. I know a little bit about that as well, but I'd love to hear kind of the journey that you've gone through as well, in different types of funding, from what I hear as well, from the start to where you are now.
Absolutely. Thank you for having me. I will tell you that UnoEth started on accident. People laugh every time I say that. And before I started UnoEth, I was a buyer for Pottery Barn from the corporate realm. And I had this idea, I'm just going to climb the ladder and do my career that way. And so my dad's from Ethiopia, and he got me a handmade leather bag from Ethiopia as a gift. And I was like, this is great. I can commute from Oakland to San Francisco every day for work and whatnot. And my friends and family and my coworkers kept asking me, where did I get this bag? I love this messenger bag. And it was a messenger style, classic style kind of leather bag. And I said, oh, it's from Ethiopia. It's handmade by an artisan. My dad got it for me. I'm sorry, you can't buy it. It's not online or anything like that. So the question kept happening over and over again. And I'm like, what is going on with this bag? I don't understand. And so I told my dad, I'm like, hey, people keep asking about this bag. He's like, babe, me too. Oh my God, we should start a business. And I'm like, I'm already working at this publicly traded Fortune 500 corporate grind company. And I'm also styling on the side and trying to buy a house in the Bay Area, which is really hard. And I'm like, I don't think so. I have a lot going on. A month kept happening, the compliments kept happening. And then my coworkers were like, when's your dad going back to Ethiopia? And I was like, maybe in a couple months or so or whatnot. Can we place a pre-order with this company that doesn't exist, this brand that doesn't exist? So I told my dad, and I was like, I think we should start on that idea that you were talking about. He's like, let's do it. So he helped our artisan partner get his leather export license.
And so I sent over some designs. We went back and forth on finishing. He sent over samples, and my dad flew back to Ethiopia with suitcases of leather bags, came back, and we gave them back to the people who had pre-ordered. We had 15, 20 pre-orders or whatnot. They told their friends, and I was like, all right, let's do a photo shoot. Let's set up a website on Shopify. Let's see how this thing goes. And so that started in February 2015. And a year and a half into it, I was dying. I was working this corporate job, like I said, and I didn't have enough time and whatnot. And I really loved what we were doing. And so after I quit my job, that's where the funding kind of started. We did a crowdfund through Kiva, small, and then we also did a small business loan. We also there are other like types of funding in terms of like with Shopify, they do lines of credit where you pay back through daily sales. We did another small business loan after we paid off the other one. There's so many different areas of where we kind of grew in that term. And then there's also grants that happened this year, different awards and prizes and things like that. So I did a bunch of different ways to get funding and keep going where we are in our business right now.
Thank you. And a quick follow-up on that. So was there ever a time where you were looking at either institutional funding or angels, along the way?
So I did meet with a couple investors and VC funds through my network. And during the time, it was very early for me. They loved what I was doing and they wanted to see what I was keep doing in a couple of years or so. But I also, in my heart, I still want to keep this a family-owned business. And so I had some reservations about that. We're still having talks about it, but we haven't gone down that path yet.
Great, thank you. Thank you. So next I want to get to Colin and Nenye, who these guys are the youngest on the panel. They're recent graduates from MIT, and they are on the verge of closing their second round, is what I hear?
We closed our seed round.
Okay, you guys have closed your seed round. Okay, yep. So what have you guys learned, about the journey of kind of going from campus to raising, that soon?
Yeah, absolutely, and wonderful to see everyone today. So as far as what we've learned so far, it's really an iterative process of figuring out how exactly your company works and proving why that company and that idea that you have is going to work. And so from our standpoint, after graduating, we ended up initially working for a couple of years just so that we could have money to be able to take that risk, to be able to jump out on our own and try out a business idea. And then as we were getting started, one thing that we did was, understand how much runway we had to be able to just operate on our own before we had to raise money, and then understand what that timeline would look like. And then when we started off on the fundraising journey, it was a journey of really proving why that business and the business idea would work. And so essentially starting off and understanding really, really quickly whether or not your business is going to fail or succeed is like extremely crucial in what that fundraising story looks like. And oftentimes you want to do that, especially in a tech business, which is what we're building. You want to do that without building tech if you can. And so one thing that we did for many business ideas that we've tried is essentially what we'll do is we'll go ahead and figure out the least tech way to prove whether or not there's a market for the opportunity at hand. And so whether that means send out Google Forms or surveys or create wireframe versions of a product and get people to sign up even without the product existing, is something that'll give investors and you confidence that, if you start building this product that you say that you're developing, people will actually buy it. And so with Sauce, as we're getting started, essentially what we did was, we started this beta program with dynamic pricing for restaurants and saying, hey, we can help restaurants make a lot more money using this dynamic pricing beta program that we're developing. Would anyone like to sign up? And so essentially we ended up getting restaurants signing up, and that gave us an indication of, hey, there's a business idea here. I think the next part that has been mentioned already is the importance of talking to a lot of people. And so as you're going on in that fundraising journey, you'll end up understanding that some people are naturally going to want to invest in your idea and some people are not. Investors and folks alike have just different propensities for what they want to invest in. And you've got to prepare to hear a lot of no's and iterate on your approach in talking to folks. And so the faster you're able to understand, what those key points of your business are and the strong points are by talking to a lot of people, the better you'll be able to frame that business story. And the more people you speak with, the more chances you'll have of running into folks who will say, yes, I want to invest in your company. And so overall, I would say it's been an iterative process of talking to a lot of people and figuring out the quickest way to fail fast, which will give you and your investors confidence that your business will succeed.
Thank you, guys. So I'm going to jump into some general questions. And the first thing I want to ask is I want to know if this issue is particularly alive for any of you. So I want to know, are any of you fundraising currently? Okay, so Don, you're fundraising currently. Can we hear a little bit more about how that's going and what that process looks like?
Yeah, I'm on my third equity crowdfunding campaign. So I raised the maximum in 2019, 2020, and then we just reached 1.3 million last week. We're doing a Reg A Plus, which is essentially like the institutional VC's version of a Series A. We can accept money from crowdfunding and institutional. So we're fundraising and getting follow-on capital from our current investors, and then we're reaching to new investors. So we're about at 4.5 million total raised right now, and then we have another 3 million to go in our round. So once we close this round, we'll be at about 8 million raised, and then we'll look to another round at the end of the year. That's kind of how it always goes. You're always either fundraising or planning for the next fundraise. But if anyone's interested in checking it out, it's at startengine.com/PopCom. And then I also have an open round I have 2 companies right now, 2 VC-backed companies worth in the millions, and the other one is called Flat Out of Heels, and that's also on Start Engine as well.
So it's my understanding that the rules around equity crowdfunding recently changed to where the maximum you could raise in a given year was $1,070,000, and that's increased up to 5 million, I think.
Yeah, that's in the Reg CF. So the Reg CF is it's just the base crowdfunding. It was $1,070,000, now it's 5 million, and then the Reg A Plus, which I'm doing, it was 50 million, now it's 75 million. Okay,
and I guess the question I want to ask you is, how do you think about, you're raising from institutional investors as well as raising from, the crowd, and you talked a little bit before about democratizing the investment and access. How do you think about weighing the money that's coming in now when you think about you've kind of got both of these levers that you can pull on?
Yeah, so I've raised over $1 million from venture capital and accredited angels, and as I said, of course, 3 million in crowdfunding. Also won about 250,000 in pitch competitions. I went through TechStars Accelerator. So for me, it's just I weigh it by the need at the moment, and also when it comes to taking VC money, I don't spread my net wide. I'm very specific. I only pitched about 30 investors to close my $1 million round because I was very intentional about studying these investors to understand if their investment thesis aligned with what my company was doing, and if they had any portfolio companies that were similar, or any LPs or managing partners that could really help my company grow. And so now that we're in the stage we are at, we're really looking for strong venture partners. So I won't just take money from anyone. They have to really be someone that I want to deal with for years. And just to share why it's so important, I had to buy out 2 investors last year because they just were sitting on my cap table and they weren't contributing. And so I didn't want them there. So I'm very intentional and deliberate about who I give equity to from my company.
That makes a lot of sense. So was there anyone else on our panel that said you were currently fundraising?
Yes, I'm currently fundraising as well. I'm also working towards my C2 tranche of funding at the moment. So the way that we're doing it is through a safe note. It's a vehicle and a tool to be able to help mitigate risk as far as giving up equity too soon, but also giving the incentive towards the investor at a later price round, whether Series A, Series B, a discount on being able to put them on the cap table. So for me, we're at a C2 right now. We I think raised about 2.2 million in total. In total with federal funding, we raised about 6 million. So right now we're on track to raise our C2 funding at 5 million, and we're probably going to close that in the next month or two. But the way that it's accelerating now, it looks like within the month we'll probably close that out. But it's a way for me to retain ownership of my organization at a rate where, as soon as we're hitting milestones, because with biotech, to get things to market, it takes a while. It takes about 5-10 years, maybe even 20. As far as products, especially with products that I'm working on for people like us, for people of color. You always have to incentivize it towards everyone else, especially with what we've seen in the last year. And that's kind of where we're going right now.
Yeah, that makes a lot of sense. So I'm curious about, all of you guys have experience fundraising. Were you the primary fundraiser, from the beginning on your team, or was there a different team member who was, solely responsible for fundraising? Does anyone want to speak to how that worked?
I'll share that. I'm a solo founder, so that's my responsibility, but I'm grateful that I have a team to really run the business, because as we all know here, fundraising is a full-time job. And as your company continues to grow and scale, as CEO, your job is really to make the right hires and keep the company capitalized. So my time is really split between team building and being an ambassador for the company and fundraising. So it was very difficult in the early stages because I was just a single founder with probably 1 or 2 team members and a few advisors. Now we're at 15 team members. But it was really hard for me to balance that. So if anyone is listening and is struggling with the balance, it's okay. We all go through it, and it will get better as you have team members to delegate to.
And then you mentioned advisors. You mentioned mentors, board members, advisors. I'm curious how for everyone how these people played a role in your fundraising process.
So I guess I'll go with me. I actually, just to echo Don's point, I was also a single founder as well. I'm still a solo founder, the only founder of the company, and the only owner of the company. So one of the things that we had to do quickly, and what I had to do quickly, was being able to bring the intellectual capital into the organization through the board. So I had to create a board and brought much more of the bigger names in the academic setting for biotech. And it wasn't necessarily in the beginning that they brought a lot of value to me. It was me still going out to the market and being able to gauge the temperature of the market as far as kind of what we were developing towards putting the effort together, as far as being able to do the fundraising, because it is a full-time job. It is something that you have to focus on while trying to build the business, while trying to build the team, while trying to build much of the products that you see on the website. But for us, the notoriety of the naming helped us in the beginning because it got us to our first government contract. It accelerated us from that aspect to then get more follow-on funding from the federal side that then trickled into much of the larger players like the Pfizers, the Mercks, Johnson & Johnson, to now want to be able to collaborate with us on a lot of deep R&D projects. So then with the notoriety of those names, they actually helped us get into some of the VCs ourselves and angel funding groups ourselves. So they actually were advocates and evangelists on our behalf without us even knowing. So I would say having an effective board is crucial. Don't just have a board where you have just people who aren't going to contribute anything. For me, I had people contribute their name to helping us grow, and they contributed the effort as far as getting us the connections. So that was much more effective for us in our growth strategy than anything else.
Yeah, I would add as well. For us, I would say just echoing off of what Reggie mentioned, the advisors have been absolutely crucial and kind of central to our fundraising journey, in the sense of, you reach out to folks, even if it's not in an officialized board way, folks that you entrust, folks that you can learn from in your startup journey, and they'll help you understand those questions that you need to be answering for your business to be a strong business and to have that unique opportunity, and for you to be able to, structure that approach to it. And then in your outreach, one thing that we've learned has been, in the process of reaching out to people for advice on the business, oftentimes, they might be able to connect you with folks who they think might be useful, or you can ask them if they can connect you with folks who might be useful. And sometimes these people might be, folks who are potentially going to be clients of yours or potential investors as well. And so being able to reach out to other startup founders who've done similar things as what you'd like to do, if it's raising money or if it's like something within the same business idea, or being able to reach out to folks within your particular market, or folks who are just on the side of having experienced something that you'd like to be able to learn from, has been extremely important to us, and something that I think every founder comes to bring folks like that into their circle.
Yeah, so the last three speakers, you guys really picked up on, kind of speaking to the value add that people are bringing, either as an advisor or as an investor. And Don, you spoke directly to that when you talked about, having investors that, you needed to buy out because they were no longer providing value. So I guess, I want to open a question, more generally to the panel, about when you think about, where you are now and think about investors for the future, what does that value add look like? Yes, in terms of, fundraising and access to capital, we've kind of talked about that, but like, what's the value that you really want out of investors?
Yeah, I think that's a very, very good question. I think that investors can contribute a lot. It really depends on their experience. And so, one thing you got to keep in mind when you're coming after investors is that, they have very varied experiences depending on the companies that they founded, the companies that they've pushed along. And you got to keep that in mind, because that's the experience that they're going to bring to the table when it comes to your company. So for example, you can have investors that are very experienced in technology, that they've built and have been on the technology side of all the companies that they've been a part of. And so, these guys are very instrumental to your thought process when it comes to the technology that you're building. Vice versa, you might have investors that are super experienced with building and scaling operations from a sales side as well. And so, it's always great to pull these people into a closed circle conversation where they can just give you very candid advice about the processes that you're experimenting with, because you can really push the needle forward when the team is small. And when you're raising money super early, the team is always small. And so, having these people at the table can be very helpful. And then, as you continue to scale, then they start to be a little bit more advisory and less team membery. And so I think it can be very valuable leveraging the experiences that folks have from the companies that they've worked on, they've raised with, that they've really pushed to the next stage, because then they can bring those experiences to the table and help you push your company to the next stage.
Yeah, and going off of Nenye's point as well, just to provide a quick example, we were just last week talking with some of our investors who, happen to be, since we're in the restaurant business, they happen to be restaurant owners, and they were helping us understand how our product markets to restaurants and how to develop marketing and campaign materials to reach more restaurants. And so that was something that, we didn't have like that direct experience from our background, but the folks that we were able to bring into our network definitely had seen thousands of times how this is done successfully. And so that's something to learn from.
And I want to, Xiomara, you mentioned, on your intro that you want to retain this kind of as a family business. And so you haven't taken, too much outside capital. It's been self-funded, and you've done, the bank loans as well as the Shopify capital and these other instruments to kind of continue to, getting the capital you need on the operating side. What would it take for you, what kind of value add would you look for if somebody, for you to give up equity? Like what kind of value add would be necessary for you to do that?
So for me, in terms of value add, I think it's really important for someone who actually sees the vision of what I want to do in terms of duplicating my business model of helping artisans all over the world start their own businesses or partnering with them in some capacity. I think that sharing that vision is really important. Also having that experience in terms of for retail. So I've talked with investors who have become my friends now, and it's great getting advice from them in terms of how to scale your business, but also they don't really have the retail backgrounds or even the connections and network in the retail space that actually would benefit kind of like my growth. It'd be great for somebody else in a different space and for apps or whatnot. And so I think that value add would be very important for me in growing UnoEth to what we've done before. But it's been great to get, because we can't, as entrepreneurs, we're not experts in everything. I'm an expert in marketing in terms of branding and design and merchandising, but not in, say, like in scaling, in accounting, finance, or whatnot. I have a bookkeeper for that. But that type of value add for me is very important in terms of sharing the vision and also in retail experience and growing brands like that.
Yeah, and I think so. I want to ask a question thinking about our audience. So our audience, you know, at Kinetic is a lot of very early stage founders, people at the idea stage or very early into their own fundraising process. And I'm curious, when you guys think about the very beginning, how long did it take for you to get that first dollar? You know, that first check, first money of any kind. You know, Reggie, you mentioned some of the government grants and things like that. So I know it comes in different forms, but how long did it take from when you first started to getting, you know, any kind of money in the door to support your business?
Well, I'm glad that you asked, Jared. So, so to be frank, I actually started my business with $600, right? So I only had hours of runway left. So I was leveraging, you know, everything that you can, like from my savings and everything else. But you know, it took me about 6 months to see the first dollar from any service or kind of innovation that we saw coming through the business. And then from there, you know, I was strategic on being able to then grow assets and grow the team at the same time. So of course, with federal funding, it takes a while to develop relationships. It takes a while to develop the pathway in which you can gain the expertise and knowledge for writing proposals. You know, I wrote proposals 17 times till the first one got funded. So it takes an effort. But I had a good team, board of advisors, help me, you know, accelerate my journey at, you know, in the beginnings, which was crucial. So that's kind of where I was at the point.
I'll weigh in as well. I've started 5 businesses since 2001. 4 of those companies I raised money in the first 3 months, and the other business is a consulting company and did not require raising capital. Of 4 businesses are still in business today. And what I find was my secret, or, you know, what helped me to raise money early was having a very strong understanding of my business model, and how I was going to grow the business and be able to show the investors how I'm going to return that capital to them. But also, as I said before, being very intentional and deliberate about who you pitch to, not just pitching to everybody. I mean, now, you know, there's so many investors now. 20 years ago, there was not. I raised my first money from friends and family for all the businesses, but PopCom. PopCom was mainly, you know, venture backed in the beginning from accredited investors, but the others I raised for flat out $250,000 from my personal network of friends from college. My father funded my very first business. I raised money for a restaurant, about $200,000 in 2019, right before the pandemic. Yeah, from my personal network. So I think that the lesson is just to build a network over years. It's not a fast process to build a network of people that trust you and will give you money, but start now building your network, positioning yourself as a thought leader, and then really deeply understand your business. And, you know, people are now looking for ways to diversify their income and diversify their portfolios as a personal angel investor. So it's a great time to start building that network now, but it shouldn't take that long. When I hear people say it took a really, really long time, I think it's a reflection of your readiness. I think it's mainly because a lot of times founders aren't ready and they don't have the due diligence done. And so it takes them a long time to raise money.
Yeah, I think that Don really has it right there. In terms of raising money, I think that your network is really, really powerful, both from whether they can give you money, but also from who they're connected to and how they give you money. You cannot really downplay the importance of that first check. If you're able to get that first check very quickly, that's going to set the tone for the rest of your round. If you're able to just work with and get the first check from anywhere in your network, that essentially just will help anybody else decide that, hey, you have signal, you have the power to get more money, and therefore I'm going to give you the money. And I think that's one of the hilarious parts of raising as well, is that as you get momentum and as more people want to give you money, you start to receive more money and more offers from other folks as well. And so you really got to put a lot of effort into that first check, and getting that from anywhere of your network is very valuable.
So one thing I want to tap into, which has been mentioned a few times, is not just raising from anyone. I'm curious, if you guys wanted to speak to what are the biggest mistakes you've made in fundraising? Like, do you have experiences of Don, obviously you do have experience of raising from maybe the wrong people or the people who didn't prove over time to have value, but any mistakes in either the wrong people or going about the process in the wrong way?
I'll share this because I made a lot of mistakes over my 20-year journey when it comes to raising money, but in particular, I think in the past 5 years, just when I first started really working with VC and understanding that animal in itself, and even though I read venture deals and I felt like I was ready, I really wasn't. And I think the biggest mistake was not fully understanding safe notes and convertible notes and the impact on your cap table of having those discounts held. What happened was I basically have fully subscribed my cap table and I was locked where I couldn't raise money. And I had to essentially give some of my shares up. I was able to negotiate for people to waive their discounts on these safe notes and convertible notes. And a lot of investors did just convert to common stock, but it was definitely difficult. I also, looking back, and I've applied this now in the past few years raising money, but in the very beginning, when it was really the most important time for me to be aware, I was really waiting for investors to give me a term sheet, not realizing that I can set my own terms. And it's important for founders to go to the table with your own term sheet. I really encourage people not to sit around and wait for investors to value your company and give your company a value, because they're never going to give you the value that you deserve, because they're not in the business of giving, they're in the business of making money. So why would they give you a higher valuation if they could give you a lower one and make more money on the back end? So just always deeply understand all these instruments that we use and how they affect our cap table as we grow. A lot of these notes have term limits on them. And if you're not able to convert these notes to equity, or in the case of a convertible note, also be able to offer a repayment with interest, you could really hurt yourself. So don't just be rushing to take money because you need it. Really understand preferred shares, preemptive rights, all these words and terms that are in these documents that can really come back and hurt you later.
Yeah, I would additionally add one thing that's kind of counterintuitive that we've learned during the investment process, and everyone's fundraising process is different, of course, and so that's one thing to keep in mind. But there's a huge difference between asking for money and presenting an opportunity. And so oftentimes it's counterintuitive, because investors are going to want to invest in people who don't need money. And you want to essentially present your business more as an opportunity rather than as you asking for money. Because the minute you go to an investor asking for money, it kind of gets into their mind of, okay, well, why do you need money? We want to invest in something that is going to just essentially grow up by itself and blow up by itself, even without us, which is it's counterintuitive to how a lot of people think. But once you start getting into that mindset, I think it becomes really powerful in how you frame that story of, hey, this is something that is huge and it's exciting. It's happening on its own. It's got traction. You can prove that traction. Like, we're going somewhere, and if you don't invest now, you're going to miss the opportunity to be an investor in the next billion-dollar company. And for an investor, oftentimes what they're looking for is those opportunities to invest in like the next greatest thing on earth. And you know, one of the biggest investor sins is missing the investment in that next Facebook or in that next like, you know, $1 billion startup that really takes off. And so being able to present that opportunity as something that is fleeting, as, hey, this is an opportunity for you to invest and make a lot of money rather than asking for money is super important.
Yeah, 100%. FOMO is
Yeah.
key.
And also
FOMO is key.
end on your round. Like you said, Colin, you know, FOMO's real. So say, listen, we're closing this round on this date. Don't let them just drag you along and float your round, because they will do that for a long time. So that's the best advice, you know, as Colin said. It's an opportunity. I'm not asking you for a favor. I'm giving you an opportunity to win with me. If you don't want the opportunity, it's going to go with or without you. And that's my attitude. I have a strong sense of entitlement and an attitude of I'm going to win without you when I go into the meeting. And it comes down to your confidence level.
Last question, and then it looks like we've got some questions coming in from the audience. But I want to ask, so, you know, talking about these different instruments, we covered kind of VC, angel, crowdfunding, and debt financing. I want to jump back on the debt financing one, because it's an interesting one that seems to be, you know, gaining a little bit of steam as people think about alternatives to venture. So I want to give, I know Xiomara has some experience with that, so I want to give her an opportunity to talk a little bit about, you know, the different options a business that has revenue, you know, might have for, you know, looking at debt as opposed to equity.
So when I first started looking into a traditional business loan, we're in our very early stages, and we started, and it was almost defeating in a sense, because traditional big banks aren't going to look at you because you're a small business. You've been in business for about 1 year, 2 years. They want to see much more growth in terms of sales and investment, or sales and revenue and whatnot, and experience. And they wanted obscene amounts of interest, very little loan or whatnot. And it made me have to tap into my resources of like, where else can I get funding? And so I learned that there are a bunch of nonprofit organizations that help small businesses like myself, who were at the time under 5 years old, in business, and tap into those resources there, whereas much lower interest rate, and tapped into more grants and to all that type of different financing. And so then you learn about Shopify Capital or Clearbank that also invest into e-commerce brands, where they actually see your sales and they invest in you in that way. You get really creative in terms of how to get money and funding. And so you get really crafty as you are an entrepreneur and whatnot. And I think that as we've grown and as we've paid off all this debt or whatnot in a very fast time because of our growth and our sales and our brand, the loans keep getting bigger, or the offers and the interest gets smaller, and we get a lot more attention from different people here in the Bay Area, especially Silicon Valley and whatnot. So it's definitely something that I want to say something. It's definitely not the most like glamorized route, but because of this looming debt that you have over you, but it definitely gives me the freedom to expand my business in the way that I've wanted to.
Right, correct. So we're at Q&A now. So we're taking some questions from the audience. I'm going to go ahead and read the first question that came in. So we've got a question from Alan Ferguson, and he says, presenting a plan for how to return capital to investors is great advice. Do you also present a plan for scalability and growth? How do you protect your idea, concept, or value proposition while searching for capital?
I'll say that's all in your deck, Alan. I mean, all of these things, the scalability and growth should be in your deck. It should be very clear how your milestone chart, how you're going to grow, what you're going to do with the money, what your projections are. That should be in your deck. And then as far as intellectual property, rule number one, you don't ask investors to sign NDAs. That's just doesn't make sense. That shows that you're inexperienced. But, if you have a product that can be patented, trademarked, or copywritten, you take those steps. If you don't, if you're in a highly competitive industry or you're doing something that can't be patented or trademark, like me with my company Flat Out of Heels. We have a rollable flat. It's not, I didn't invent it, but we have very unique things about our product that differentiate. So you just really focus on the differentiator. But I always tell founders, you know, it's very rare that someone steals your idea. And even if they try to, no one can do it like you. So just stay on course. I always like to reference things like, how many brands of tissue are there? How many bottled water companies are there? There's enough market share in the world for whatever you're doing for you to do well and someone else to thrive and do well. So just focus on what you're doing and you'll be fine.
All right. As we wait for other questions, does anybody else want to speak to that? Thinking about specifically around how do you protect the idea or concept while you're searching for capital?
Yeah, you know, I would agree with Don as well. I don't think that you need to worry too much about folks coming in, swooping in and taking your idea. Being a founder is tough. It's very rewarding, but it's tough. And no one's just going to jump at the bit just to do what you're doing, even if they think the idea is great. And so, you know, I think that, you know, you shouldn't worry too much about it. And you should just really be clear on the value that you're bringing to both your customers, but also to the investor. You know, we're going to grow this way, and this is going to be the kickback. Yeah, this is what's going to make sense. This is how things are going to play out. Investors are very smart themselves. They do this for a living, and actually they be working through a lot of deals, much more deals than yourself, and so they'll know what they're looking for. They'll ask you the questions, and just by answering the questions, you'll be able to fulfill, you know, 90% of what they need. And most of these investors, their prerogative is to make money from investing. Their prerogative is not to go and do your business. That's not something that they're planning on doing. And so yeah, I would just approach it with that mind of be as open as you need to be. You know, you don't need to give up your secret sauce. If you have secret sauce, like keep that under wraps, but you know, you should be pretty comfortable sharing a lot about your business, about your metrics, about what you're planning on doing, about where you're trying to go, because that's going to really help the investor get a good sense. And then also to share that with other investors, which they will 100% share with other investors in the back end. Like when you're talking to one investor, you're talking to all investors. You got to keep that in mind as well. You know, that's just going to be very helpful as you move forward. You can't really keep it under wraps, and so you might as well share. And they're not going to do your business. It's just hard. They want to make money off of, you know, yourself being able to push the needle forward, and not necessarily them going and sourcing a bunch of people or doing it themselves to go and push the needle forward on your business.
So I see a great question that just came in that says, you know, we talk a lot about fundraising. But what happens when the money actually gets into your account? You know, what happens the next day? And what this makes me think about is, you know, sometimes along a fundraising journey, you realize the story that's working may be a bit different than your actual plan for how to actually implement, you know, that and put that capital to work. So, you know, once you raise that money, you know, what happens once you kind of close the round?
You do what you said you were going to do with the money. I mean, you should have this plan. This is in your projections. Whatever you were telling them you were going to do, start immediately, because they're going to want you to be accountable. And I send monthly investor updates. Everybody doesn't have to do it, but they love that I do it. When good things are good, I let them know. When things are going not so good, I let them know. And I'm transparent. And it doesn't, I'm going to tell you, it's never went the way I thought it was going to go. Never, not once. Never, not once in 20 years. So just tell them that, you know. And I come from the side of where Xiomara's at, because I did everything she did as far as Shopify Capital and ClearBank and all those things. And I'm still the biggest fan of customer money over investor money, because then you don't have to deal with all that stuff. But if you do have to take money, just be a person of your word and be transparent when it's not going well.
For me, when the money comes, it goes directly to, like Don said, what you said you're going to do with it, but invest in inventory for me and marketing. Those are the top two places where my money goes to keep my business going and growing, and also advertising to current customers and retargeting, and also to new customers too, because that's exactly where it goes.
Got it. And I think we might have time for one more question. So, we got a question from George Whitfield that says, can you speak about the key proof points that you worked to achieve in the early days with limited resources to de-risk your business and strengthen your pitch? So kind of those key wins or key, I think Colin and Nenye, you guys talked about that, kind of having those early signs of success that help you get there.
Yep, absolutely, and we can be really quick with this. Essentially, for us, the early signs of success were really people signing up for a product. If you're in a technology business, oftentimes as investors will believe that you can develop the technology, or you can bring folks on who can develop that tech. But is the market there? Do people want the thing that you're building? For us, with what we're doing in Sauce, but then also with what we were doing previously in our previous pivots. One of the most important things has been, can we, create something that people want? If we push this website out or we push this product out, pretend a product, will people sign up for it? And if not, then you know where to adjust. If people do sign up to it, then you have a business.
I keep being on mute. I'm curious what Reggie would have to say on this, because since you're working with such a long time span, what are you proving to get money in the door?
So thank you for the question. So with biotech, you always have to show the science first before you show business. With us, we had to show the specific use case, the specific patient population, the specific scientific merit behind, and have it validated towards 10, 12 different groups and, hospitals and doctors. So those are the key opinion leaders that we actually had to validate our even science towards, from even getting money from even the DoD. So just understanding that from our innovation, we didn't actually have a lab in the first 6 months of the business. We started leveraging other labs to help us, grow what we needed to do. However, from the scientific research that we've done, we had to be able to show, okay, these are the long timelines of developing this specific vector for this specific case or this protein or this specific device for this specific use for cancer, and show why it's important, why is the indicators there, and how that it pertains to the specific total addressable market and potential addressable market within the first timeline that you have projected initially. So then for us, it went through the whole key opinion leader validation, and 11 out of the 12 agreed on our approach. So that's how we leveraged that opinion to get into some of the DoD and even further venture funding or angel funding that we're able to attain.
All right, thank you for that, and thank everyone on the panel. This was such a rich conversation about all the different, we learned about all the different ways to capitalize a company. We've learned about the different ways to approach investors, and we've learned a lot from your mistakes that you've made in raising and the approach to raising. So I want to thank you again. We're going to wrap this session and we're going to throw it back to our event host, Morgan Franklin.
Hey everyone, that was amazing. A few key takeaways. Protect yourself and your equity, be confident, and know your options. Thank you to all the amazing founders that just spoke with us.